Welcome to Start Fundraising 101 for Onevest. We're so glad you joined us. Thank you so much for spending some time with us. We hope that this webinar will be useful in helping you identify better ways to fundraise, more clarity on some of our views for Start Fundraising. At the end, we will be addressing as many questions as we can. Feel free to be submitted them during the presentation. Our team here is taking note of those questions and will be sharing them with me when the time is right. So before I get started really here with the presentation, let me share a bit about myself. Early on in my career, as early as when I was in college, I knew that I wanted to start and grow my own business as an entrepreneur. I really believed that the power of wealth creation and solving problems was what I wanted to do with my life. Having said that, after graduation, I did start off in a more traditional investment banking, management consulting career path, to be completely honest, to pay off student loans and build a bit of a savings so that I could then go and start a company with that. And since then, I've had failures and successes. They're all some painful, others very joyful. But in the process, of course, I've had to fundraise more than once, some with success, others without. I'm currently part of the Onevest team as one of the co-founders here, and we're working hard at creating a platform that helps solve some of the challenges that we as entrepreneurs face when we need outside resources, in this case capital. So we'll get into that a bit later, I hope, and if you have any questions, we'll be able to elaborate further upon it. But bottom line about me is that I've been there, I've done it, I got a ways to go for sure, but I think I have a lot of experience that I'm going to be very happily sharing with you. So, because of the business we're in, it's finance and highly regulated, we do need to make some disclaimers. And I guess the biggest one here is that we are not a broker-dealer, but we do work with one, WealthForge, and any securities that are offered on our platform are offered through WealthForge as a broker-dealer. And of course, we're not asking you to invest or not. This is just a webinar about Startup Fundraising 101. Okay, so let's go over our agenda briefly. We have about an hour. I guess by now, about 50 minutes. We will try to leave at least 10 to 15 towards the end so as to answer as many questions that you may have. I'll start up by talking about some of the fundraising sources, covering some key terminology that surely you've heard about, some of the pros and cons of taking outside investments, to begin with, and how much to fundraise for, what do investors look for when you're pitching and when you're soliciting their capital investment. A bit about the Jobs Act and equity crowdfunding, which has had a major impact in the capital industry in the United States, and of course something we're very participants on. And then we'll enter into the Q&A. I would say that at the end of this webinar, as a follow-up, we're going to ask for your feedback. And we're going to ask for your feedback in a very simple way, just asking how satisfied you were with the webinar. But also we'll send a follow-up email with a bit of a survey, and it won't take you long, but we would love to get your feedback as to what we could be doing better. And as we go through this webinar, if you think of something about what I said, how I said it, the content, what was there, what wasn't, anything you think we could be doing better, take note of it, and please spend a minute or two afterwards sharing that with us, because it will make a difference. Okay, so just a very high-level overview of fundraising sources. We got the typical friends and family rounds, Uncle Joe and Auntie Annie. We got crowdfunding, which we'll talk more about, the typical venture capital industry, accelerators and incubators have increasingly become a source of funding. They're not just providing soft support, but actually investing money into early stage companies. Clearly bootstrapping, so your own savings, and just being very frugal about how you make use of resources. the so-called angel investors, and one that we love here, which is your customers. And that's a great source of funding. Typically, you might not think about it as a source of funding, but they really are if you think about it. Your sales, your pre-sales could really end up being the money that gets you going or helps you get to the next stage if you do it right. Now, let's talk about all those options, but where do most entrepreneurs get most of their funding from? And believe it or not, most of the capital does come from your own savings. It doesn't mean that if you don't have savings, you can't get a company started or that you're destined to not be able to capitalize yourself, but it is where most of the current capital comes from. And second to that, believe it or not, is credit cards. Then comes family and friends. Most people think that family and friends are the primary source of early stage funding, and they're not. Banks plays a role here insofar as sometimes you decide to take out a mortgage, sometimes you take out a personal loan. Hardly ever will a bank give you a loan for a startup, especially in the technology space where there's no real solid collateral. But you can use banks providing other sorts of collateral to fund your company. And then by the time it gets to venture capital or angel investing, as big of an industry as that is, they are actually they have a less than half by a long shot, a small sliver of the overall source of capital for early stage companies. So some key terminology. Let's talk about crowdfunding, because a lot of people mix crowdfunding, Kickstarter, Indiegogo style with what we at Onevest do and some of our peers in the industry do. And the key differentiation is that while you are in both types of crowdfunding getting capital, one is essentially donations. You're most of the time either pre-selling your product or service or providing some sort of reward, and that would be Kickstarter and Indiegogo. That's great. Obviously, it has the benefit of being non-dilutive, and it has its own value. What Onevest does and what equity crowdfunding means in general is that you are actually raising investment money and you're giving up equity in return. Now, you might ask yourself, and by the way, I've been told here that maybe it's a good idea to turn off my video for quality, so I'm gonna do that, but I will be here. I'm sure you won't miss my face. All right. So you do give up equity in equity crowdfunding, and you might ask yourself, why would you do that when you can get capital from Kickstarter, Indiegogo, or any number of others without giving up equity? And well, the biggest reason, in my opinion, is that you give up equity, but you get investors, and that might be obvious in some regards, but you get people who are literally invested in your success, and that is very powerful. For you to not only have people who think you have a cool product, but actually they put money on the line. Believe me, they're going to go out and they're going to talk about your company, they're going to talk about your service like no one else could, just because they stand to get the first batch of whatever product or service you're selling. So that is extremely powerful and a key differentiation. And it isn't just promotion, it is the ability to tap into their collective wisdom and experience, and if you do it right, you can get not just money, but board of advisors and supporters, and that is extremely powerful. Also, on average, you probably stand to be more successful raising higher levels of capital through equity crowdfunding than through donation crowdfunding. I got no empirical evidence for that, but if I look at a number of campaigns on equity crowdfunding platforms versus donations platforms, because you're getting something in return as an investor and the possibility of an upside, they're more generous with their wallet. To give you an idea, on average, investors on our platform are writing north of $20,000 checks, whereas in some of these other platforms, there'd be hundreds of dollars at most, if not dozens of dollars. All right, so I'll breeze through the other ones. If you want me to elaborate upon any, then put them in the questions. But a term sheet does not mean that you're going to get an investment from whoever gives you a term sheet. It just means that they're interested. So if any of you have a term sheet, I hate to burst your bubble, but that doesn't mean you're going to get the money. It just means that they want to take a closer look. And then there's a process of due diligence that gets started. Cap table, that just means technically it's capitalization table, and that's a summary of the capital you have received, both in equity, pure equity form, preferred equity, convertible notes, anything that is or can become equity. You put it all in a table and you say who owns what or who stands to own what, and it's a summary of your capital and your investor base. Your valuation, that's obviously how much the company is worth, but people sometimes confuse the pre-money versus post-money valuation, and it's a simple distinction, but a very important one. Post-money valuation is usually the figure that you use as a denominator to calculate the percentage that an investor is getting when they put in, for example, $100,000. They put in $100,000 and they get 10%, that means your company would be worth post-money $1 million. And that pre-money, it was worth $900,000. So pre-money is if you take out the new money coming in, the new capital, how much are you left with in terms of value? That's pre-money. And once you add the money in, how much is the total pie worth? And again, that's the number you want to use when calculating percentage of ownership. Dilution is how much equity you and other shareholders are giving up. A convertible note is it's an instrument. Technically, it's debt, but the intention of it is to eventually become equity. Therefore, the conversion nature of it. It's easier to structure than a full equity round. It has its downside, it has its upside, but it's commonly used in the early stage funding rounds. Common versus preferred stock, usually founders get common stocks. Preferred stocks are usually the angel investors when they get equity directly, and they come with special conditions, the most important of which tends to be they stand first in line to get their money back before they make any profits, before any of the common shareholders gets any of their money back. So, a quick survey now, a quick poll here. I would like to just get a sense from you, how many of you have ever tried raising money for a startup? So if you could please, you should be seeing a poll now on your screen, and it'll only take a few seconds to do that. I'm just going to be back on video. You can choose to not see me if you don't want, but it feels a bit more authentic if I'm here with you. So do we have the poll going? Okay. We'll give you a few more seconds here to finish it. Simple yes or no. All right, 10, 5, 4, 3, 2, 1. And so the results of the poll are that most of you have tried to raise money for your startup or a startup. Trying to get the exact percentage here. Tiffany, what do we get? So 60-40 basically. 43-57. That's good. Okay, that helps. So for most of you, 60% of you, you've been there, you've done that, successfully or not. A lot of these things you can relate to. So how long does it take to raise money? And you see this graph is a bit complicated. But if you study it, and the slides will be posted afterwards with the video, you can take a closer look. But to expect a fundraising effort to be less than 6 months in duration is it's aggressive. 6 months is about right. And what's very interesting is that you just don't know exactly on day one where the money's going to come from. And that is fine. I want you guys to know that is fine. You don't need to know on day one who's actually going to be your investors. It helps if you have some potentials, very high potential investors or people who might know investors, but it's okay. You can see here in this graph, and Brendan Baker put this together some time ago, and it's available online, and we're using it, but it was a beautiful visualization of what it took on average for a lot of these efforts to pan out. And you can see the size of the bubbles is how much money ultimately got invested and by whom. But you can also see that most of these bubbles don't have a direct line to an initial point of contact. So this particular data set had a few data points from which there were referrals, from which you had investors. So the most important thing is to be in action, to pursue conversations, to explore possibilities. I know people say don't take no for an answer, but sometimes no is the answer, and that is fine. But then ask for a referral, and who do you think might be interested, and can you please make an introduction? So again, 6 months, and it takes a long time, the traditional way. Now, should you take outside investment? And I'll just say that for those of you who are fortunate enough to build a very high cash flow generative business, you might not need to do an outside round, and that's fine. You don't need to do it at all. If you do, with cash flow or not, obviously you'll have the ability to hire faster. That can give you the capacity to execute more effectively and grow faster, which will make you launch faster. You can experiment with more things at the same time. So building a startup is a constant process of experimenting, and you can think of doing one experiment after the other in a very one-track manner. And for some of you, that is the only way and the best way to pursue, and for some businesses, that's fine. But with capital, you could have a wider team, you can have more initiatives, and you can be trying multiple experiments at the same time, so that once you start to identify the things that work and don't work, then you do more of those. So if you're linear, it's going to take you longer to get there. If you are doing multiple things at the same time, then you have a better chance to figuring it out. And as I said earlier, your investors are literally invested in your business, so they're going to do what they can to support you, and it's not going to be a flying solo experience. Obviously, the cons here, you're going to give up some equity and ownership, but I just want to say, don't get hung up on that. You've probably heard this. It's a bit of a repeated often, but you're better off really having a lower percentage of something that's worth a lot more because you brought the right resources than just staying with a super high percentage and not moving as fast or not perhaps ever getting there. And don't underestimate the responsibility you're taking on when you receive capital from investors. For many of these people, these are their savings or a healthy portion of them. So they're going to want to hold you to account, and you are now accountable to those investors, literally. They own a piece of your company, and you have a contract to deliver value for the value they gave you through the capital investments. And that means you're going to have to answer to them. And for some of the investors, they might want to be more persistent, and they might be more pushy, and that has a cost. That has a distraction cost, a time cost. So do consider that, and actually you should consider it when you're selecting who to take money from. Don't just take money from the person who will write the first check. Really understand what's their expectations from you after they make the investment. So how much should you fundraise? Well, the best way that I like to think about fundraising needs is to consider what do you want to achieve with that money. And don't think in forever terms. Don't think even in 5 years terms. Like, consider what you want to do for the next 18 months. If you could really have it your way and you can raise a healthy amount of capital, what is feasible for you to achieve in the next 12 to 18 months? And that's going to have implications. That's going to, you back into the amount of money by saying, well, what's the team I need to have for that? What type of investment in marketing I need to do for that? What type of equipment I need to buy, or what type of infrastructure I need to rent on the cloud. And obviously you go from where you want to be and you back into the amount that you need to get there. And I think it's very healthy to add a margin of error of anywhere between 25 to 50%. And that number, whatever that number is, should be what you seek out to fundraise as a guiding post. If you do much more than that, you could be running the risk of raising more money than you actually need. 18 months is nothing, but it's also plenty of time to show that you can create value and then command a higher valuation the next time around, and therefore not dilute yourself as much in the short term. And to do less than this is going to potentially put you in a position where you have to immediately then go back into fundraising mode. Because consider it that if it takes you 6 months to do fundraising, and that's, you know, not being overly conservative, and you only raise money for, let's say, 9 to 12 months, then 3 months after you are finally close doing the fundraising, you have to go back and start another round of fundraising. And that's just very distracting, and it'll keep you from actually building value in the business. So what do investors look for? The team is huge. Most investors will tell you this directly, and it is extremely important. And I'm just going to make a parenthesis here because I know it says what do investors look for, and that implies that that's what's important. Don't step over the possibility that you're partnering with the wrong person, or that you have partnered with the wrong person. This is your life. It really, you're investing so much of it into the venture you're trying to build. You're investing your time and your money. And if you're not with the right team, it's just going to be such a drain ultimately. And at best, it's going to limit your possibilities. So spend a lot of time making sure you have the right team around you, and your co-founder, obviously, is most important, or co-founders, but also your you know, the people you bring to the team as employees, especially that first batch of 5 to 10. Those are going to really make it or break it for you. So regardless of the fact that investors do look for that, do it for yourselves. The idea is important. There's a lot of talk about ideas, you know, are cheap on a dozen, and ultimately by themselves they're worthless by themselves. But you can have the best execution capability in the world in pursuit of a bad idea, and you're still not going to succeed. And if you do, you might end up succeeding in something that's puny in the big scheme of things. So have an idea you're inspired by, have an idea that you've diligenced, to have an idea that that stands a chance to make a difference, and for you to be fulfilled if you achieve that idea. And be open to evolving that idea and pivoting as you start to execute, because if you don't, then you'll get stuck potentially with a fantasy that you'll never be able to achieve. But don't underestimate the idea. Spend time on it, develop it, and be inspired by it. Your traction is important. Oh, and by the way, when you communicate it to your investors, that's exactly what they want to hear. They're investing in you and your capacity to execute, and in the inspiration that your idea might bring to the table. And I'm not just talking about kumbaya inspiration. I'm talking about, you know, can this really have an impact and generate wealth? Traction is key. Whatever traction you have, highlight it. Even if you have 0 sales, even if you have zero customers, if you have, first of all, create traction. Like, you know, do something about the idea you might have. Not just talk about it, do something, but then make sure you communicate what you have done. And what you have done could be as simple as, I've spoken with 100 people, and this is the survey results I have. 90% of them say they will do it. They would buy my product for this price point. That's very significant. So make sure that you not only talk and think about your idea, you create traction and then communicate the traction. Even if it's small initially, make sure you communicate it. Look for a large market opportunity. It's unrealistic that a startup is going to overnight have 20% of a market. So you should be in a spot where if you only had a small percentage of it, it would still be a meaningful business. Go after 100% of the market. As Peter Thiel might say, seek to be a monopoly, and that's fine. But know that you're better off in a market that is large enough for you to still be a viable and successful business with a small percentage. And so the investors are going to want to know what your market is, what's the size of the market, and what is really the opportunity. And they're going to want to know what your competition is like. And they're going to want to know that less, and trust me, I think it's less about what really differentiates you from the competition, especially if you're an early stage company, because that will evolve over time. But it's about getting a clear evidence of you knowing the market you're in and who you're up against, and to make sense of your plan and your execution that you're putting out there as to why are you going to do it this way. Well, look, this is what the competition is doing, and I'm not building my business as a result of the competition, but I am aware of it, and this is why I'm doing it the way I'm doing it. So it's very important as a way to communicate thoroughness and seriousness in your commitment. Pitch deck, what to include. I could go on and about this one, and I won't. I'm going to kind of breeze over it. Feel free to go back to it and take a closer look if you want, and ask questions as well. But don't forget the ask. I guess I will highlight that. Don't forget the ask. Tell them what you want. Tell them what you want them for, and then ask them for it. So, you've raised money. Now what? Now what? Communicate with your investors. Don't not do that, guys. It's very important that once you've closed the round, you keep your investors in the loop. One of the biggest value they can bring to the table is not the check. It's what they will do for you after they've written the check and because they've written the check. But in order to do that and to be effective at it, they need to know what's going on. They need to know what you need, what your challenges are, what you're stuck in, what you're wondering, what decisions you're trying to make. You don't need to overdo it, but realize that if you do it and you do it well, you tend to get so much from your investor base than just a check. And you're going to need money probably at some point in the future. And the best source of future money is your current investors. You might find that you have made progress and you kept your investors up to date, and that you're now needing another investment, another bridge round, or whatever the case may be. And if they know about this and they understand and they've been in communications with you, and now they have an added level of trust, that you won't have to go and do another typical fundraising round, but that is only possible if you've been in communication with your investors. So don't underestimate that. Focus on milestones. Don't just go out and start burning cash because you said you were going to hire X number of people, and those are not the type of milestones I'm talking about. Focus on the milestones that you need to achieve and back into that achievement with the least amount of resources necessary, but focus on achieving the milestones. And don't forget to celebrate. Raising capital for a company is very challenging. A very small minority of the population ever gets there. So celebrate, recognize your achievement, and then get back to work. Okay? All right, so next slide here, a quick poll. We're going to try to do this one a little bit faster. And Tiffany and Kasha here that are with me, they're going to help me on that. So how many of you are familiar with the Jobs Act? Yes or no? Real quick. Let's give you 15 seconds. Go. All right, 5 seconds. 4, 3. Okay, what do we got? Okay, good. Most of you know about the Jobs Act. About 70% of you know about the Jobs Act. And that's great. I'm glad to hear that. I won't go too far into details about it. If you want to know more, ask the question. But I think the biggest things here is that in summary, and what you really need to know about, well, you need to know as much as you need to know about if you're going to pursue general solicitation. But the Title II of the Jobs Act made it possible to do general solicitation. That means you can tell the world freely that you're doing fundraising. That was illegal before. Literally, publicly telling the world you were fundraising, and the SEC would consider that offering insecurity was illegal, and you could go to jail for that. And don't ask me how all these pitch competitions and pitch events, in a way, were not in violation with this if it had been strictly interpreted rule. But the good thing is that now it's gone. Now you can do general solicitation. It has implications, though. If you go down the general solicitation path, it has implications, and you can't just choose to be generally soliciting for a month and then not generally soliciting for another. If you go down that path, you're in that path, but it opens up a world of possibility in leveraging technology leveraging existing networks of your own, whether it's traditional social media or through our platform or a platform like ours that has already a robust network of investors. So very much worth your consideration. And then Title 3, which is forthcoming. Nobody really knows when it's supposed to happen. It was supposed to happen last year, and I have a feeling it'll probably happen in Q3 or Q4 of the current year, but it's going to happen. Makes it available for anybody to invest in your company. So even though today you can now tell anybody about your fundraising efforts, you can only receive capital from the so-called accredited investors. And this is if you go down through general solicitation. If you don't do general solicitation and you only tell people with whom you have a pre-existing and meaningful relationship with, then you can take money from whomever, no matter what their net worth is. Hold on one second. I'm not sure what that is saying. Oh, okay, sorry. Well, okay. Kasia just confirmed that I misread the results. Most of you do not know about the Jobs Act, so I'm glad I'm going into the level of detail that I'm going. And if you want more, ask about it. And if not, there is resources on our website that you can click, and it says, you know, what's the Jobs Act thing all about. But as I was saying, if you don't do general solicitation, if you are only soliciting investments from people with whom you have a pre-existing and meaningful relationship, you can take money from Uncle Joe, from your cousins, from your brothers, from your teachers, from your friends. I mean, it doesn't matter what their net worth is. It's not your problem. But if you go general solicitation, then you can only receive capital from so-called accredited investors, as defined generally as individuals who either have a net worth of at least $1 million, excluding their primary residence, or B, who make more than $200,000 per year consistently. As an individual or as a couple, $300,000. So I'm not giving you legal advice, but it definitely makes a difference whether you do general solicitation or not into how many people you can reach. And now, for most people, there's a lot more potential investors that you don't already know that you could only get to through general solicitation, which is part of our business model. Now back to Title 3. What Title 3 will enable is that people who are not accredited investors will also get to invest into early stage companies if you go through general solicitation. There are going to be rules and regulations, as they always want to make, about what's best for individuals, and that's fine. Those rules are not come out yet, but when they come out, they're likely to say something along the lines of, yes, anybody can invest, but if you're not an accredited investor, you can invest a maximum of 10% of your income or 1% of your net worth, or whatever the case may be. Those are the type of rules they're thinking about. And they will also probably demand a higher degree of disclosures as to what your business does, what are the risks, and what have you, so that these non-sophisticated investors can have all the information available to them. Oh, and by the way, I have heard a misconception here. Without being a lawyer, you know, trusting the advice we're getting from our lawyers, who are very good at what they do. Misconception is that if you go through general solicitation, you have to, and leveraging Title II of the Jobs Act through a 506C offering, that you have to do all sorts of disclosures to the SEC, and you have to put, you know, super complicated and detailed, prospectus. And the answer is you don't, because you're dealing only with accredited investors. And although you have to be forthright about the information and you have to share material content, there's no prescription as to exactly what you need to share, and accredited investors are expected to be able to deal with that. So, equity crowdfunding, which is made possible through the Jobs Act, because you can now leverage technology to let strangers know that you're fundraising, has tremendous value. And we think of primarily three pros of equity crowdfunding. Clearly, one of the main ones, you get to promote your company to a large pool of investors outside of your personal network. That also saves you a lot of time and effort. Literally, with the amount of effort that you might spend on Onevest, you are having a multiplier effect of that through our investor community. And the same dynamic would apply, I suppose, with any other equity crowdfunding platform that's respectable and it's our peer. We think we're better because we really take the time to work with you, and we don't just give you the technology and let you go at it. We do that, but in addition to that, you will find that we really understand your business. We have investor relations personnel that goes out and doesn't just send an email to our network of investors, but has calls with them and explains to them on your behalf what your business does. And so you do get a multiplier effect. The second benefit is that it allows for smaller investment minimums, which allows more investors to participate. And this might be counterintuitive for some of you, because for most of us, for the longest time, we thought that doing fundraising for the least amount of people was the best thing, because after all, you don't want to have to deal with a lot of investors, right? Could be right, but it could be wrong. And if you have a lot of investors, $5,000, $10,000 each, then you have a lot of people, a lot of ambassadors out there looking out for your best interest, looking out for the next referral, talking about your product or your service and trying you out and giving you advice. So, that literally gives you a wider network of people that can invest into your company and then upon whom you can rely for value. I guess that's number 3 as well. And number 2, another benefit would be that you can then have people on your cap table that would not have been possible before, because if you're only taking $50,000 checks, then a lot of people would just be disqualified on that basis. So those are the key benefits of crowdfunding. There's several others, and I'm happy to elaborate upon them if you want. Just ask the question. So before we go into Q&A, though, I would very much appreciate if you could fill out a quick survey, which will be coming up, or it's a poll, really, just like the ones you were doing earlier. If you could fill that out and just tell us how satisfied you were so far with the webinar. And we're going to answer questions, but I'm just curious as to what I shared so far, the content that was provided. Did we cover all the bases? Was it insufficient, or was it, a good overview? So if you could please take a few seconds to answer the poll. You should be seeing that on your screen now. I'll give you 10 seconds to do that. Okay, so wrapping it up. 5, 4, 2, done. Okay, so we'll take a look at that. Really appreciate your input. So next steps is visit us at onevest.com. Go to learn.onevest.com as well. There's great content there about startup fundraising and many other things. You can find us on Twitter, on Facebook. Anyways, this is kind of just going through the motions. But check us out. We would love to work with you and help you raise capital for your venture. We have to, be selective, of course. Part of providing the level of service that we provide is that we just simply can't offer it to everyone. And you will find some criteria on our platform as to what we look for. But check us out. Even if you're not there yet, we would love to hear from you and have you on our radar and just be part of your story and help support you. Even if we can't help you with fundraising immediately, might be able to help you with some referrals or just giving you some guidance. So if then you could start submitting your questions if you haven't. Tiffany here that's with me is going to start showing me some of these questions, and I'll just start reading them off while more questions come in. So the first question is from Edward, and the question is, what if I'm a single founder and I need to raise capital but can't build a team? What's the best route? So chicken or the egg type of approach, right? I mean, I need to build a team. Right now I'm the single co-founder, but I need to raise capital in order to build a team. The best route, if I'm understanding this correctly, to do both, build a team and raise capital, would be first and foremost to be clear on what you want the team for. Who is it that you're looking for, and what value are they going to add to the business? Do you need a technical team member? Do you need a marketing team member? Do you just need a scientist? What do you need that person for? And then go out and find that person. Like literally go and find your ideal candidate, whether it's an ideal co-founder who is only going to be able to join once the business is done fundraising, or whether it's your first employee. Go find the person, literally. And then that is your best excuse for why you need the money. And you say, I need the money to hire this person. And you know, that makes it very tangible, if you will. That makes it very credible, and that you are in action. And it shows that you don't just want to hire somebody, that you found somebody and the ideal candidate, and you probably convinced them to join the team once you get the money. So that would be my advice to you. I hope that answers the question. So the next question is from Kelly. Kelly asks, is there a general rule of thumb for what size the market needs to be considered for venture investment, i.e. $1 billion? Well, first of all, you know, we're not venture capitalists ourselves. We work with them, we have many partnerships, and we understand the space. But to answer this in a way that is accurate for every VC is impossible. Normally, as a rule of thumb, as you call it, for sure, if the market is not at least $1 billion, you're going to have a hard time getting venture capitalists interested. And for a lot of businesses that can be very successful, the market might be a smaller niche. It could be $100 million markets, but if you can capture 70% of that, there's nothing wrong with that, and that is fine. But for many VCs, that might be just too small. So unfortunately, if I do believe if you don't have a market of at least 1 billion, and you know, gee, they seem to have been growing so much lately in terms of what they expect now, 10 million or 10 billion or 100 billions. But you know, it has to be a big market, a big addressable market, because it's not like the United States, or it's not like all men in the world or all women in the world or everyone who has a dog. The total addressable market. And I suppose it's fair to say that the more granular you become in your addressable market, the smaller it can be, and the more okay it is, because they understand that you know really the size of your market. All right, the next question is from Dennis. How do you define when you officially start soliciting? Just discussing with anyone? Boy, that is probably a technical question, you know, if I was to answer it from a legal point of view, and I'm not going to because I'm not qualified to do that, Dennis. But I would say that if you're casually speaking with people about your venture and the fact that you're fundraising, that is not the spirit of, you know, the limitation here of general solicitation. Again, I'm not a lawyer, but from what I gather, it's not the spirit. The spirit is when you get in front of an audience and you pitch your business and you say you're raising money and that you want them to invest in you, then you're generally soliciting. You could still get away with pitching your business in public. You just can't talk about that you're raising money and that you would want them to invest in you. Some lawyers might disagree that, you know, hey, you can say that you're raising money, but then you can't ask them for money. So that critical slide of the ask, you know, if you put that in there, then for sure you'll be generally soliciting. So anyways, just be wary about that. Nothing wrong with doing general solicitation, by the way. You can do that, but once you go down that path, you can't go back. All right, our next question, it's a bit of a longer question, is from Stephen, and the question is, if we wanted to partner with investors who will make a commitment of 5 years, should we make that known in our initial communication with them, or will that limit us by possibly excluding investors who might be swayed? That's a great question, Stephen. Do you tell them up front that you only want people who can stay in for 5 years and then risk losing some that wanted 3 years, but if they're, you know, swayed, they would have stayed 5? Or do you not say anything? If for you is an absolute deal breaker that they have to stay for at least 5 years, then it might behoove you to say it up front. An alternative is that you don't say it up front. It's implied in the type of investment that they're making into an early stage company, but then to bring it up early on in the conversation. Give yourself the chance to be heard, I guess, right? And to pitch them. And but then bring it early on, and don't waste your time, because you might as well find out early that they're not the right fit and not waste your time pitching them on it if they're not going to be there for 5 years, if for you that's a deal breaker. So as long as you are honest and transparent throughout the conversation and with yourself, you'll be fine. But to be specific, what I would do is that I would say that up front, because most of these people know it already. I would say, looking for investors who can commit at least $20,000, $50,000, $100,000, $10,000 each, and to be okay with not having liquidity for at least 5 years. And then just be upfront about it. That's probably the best chance. Okay, the next question is from Sylvain. I hope I said that right. Question is, are there networking circles that are recommended to meet investors that actually work well? So there are networking circles that are recommended to meet investors that actually work well. Yes, Onevest is one of them in a way. Maybe not in how you meant it, as in you might have meant it, is there some sort of networking, club or meetup group that work well? Many of them work well. Look, go to Meetup, put the keyword investors, and spend an hour or 30 minutes going through meetups in your area, and surely some of them will have real investors, and go out and meet them in person, and they'll work as well as you're effective at enlisting their interest and have a compelling proposition in your business and in your team and your ability to ultimately execute. So I encourage you to do that. I don't know off the top of my head, I don't know where you are, so it's very hard for me to tell you, a network that's national, other than a network like ours or some of our peers. That's what we're doing. That's our business. That's what we've gone out. We build an investor network, and then we help you access that in the most effective way. Next question is from Michael. What is the typical range of the ask for a seed investment, and how much equity is given up? Well, those ranges have widened and especially gone up over time, but I think that it's still accurate to say that those ranges for the first round seed money, if you will, can be around 200,000, probably in the lower range, and probably up to 750 to $1 million in the higher range for the seed round. And I know it's a big range, but it just depends so much on what you're going to use the money for, and how much progress and traction you have by the time you do your seed round. And in terms of how much it's typical to give up, that also ranges, but you probably won't get away with giving up less than 10%, but you definitely don't want to give up more than 30. And that's a big range, I know. I think the sweet spot's probably between 15 and 20%, ideally for you, for that amount of money. But again, it's going to depend on traction, and all else being equal, the more traction you have, the more money you'll be able to raise, and the less equity you'll have to give up. So the next question is from Sam, and Sam asks, how important is the business plan and pitch deck in order to get in front of investors? I ask because I am the type of person who can deliver better in person as opposed to in writing. That's a great point, Sam. So the importance of the pitch deck or the business plan is to get you in front of the people. So don't feel like you have to put everything out there. In fact, I think the most effective investor decks or pitch decks are the ones that provide just enough to get you in the door and give you the opportunity to present, but not too much where they think that they can just pass the page. Make them curious with information that is relevant and interesting, but don't give it all in writing, because then you're right. What do they have to look forward to if it's all in writing? Business plans, it can be done in a way that they're actually counterproductive, in my opinion. And this isn't true for every single type of business. For some businesses, you just need to really plan things out much better, and not only you need to, but you can, because it's a more predictable environment. But for so many others, and perhaps most of them, you just need to have a general sense of direction and what you're going to do with the money. What is it that you're going to do with the money? That you should have quite clear. And whether you call that a business plan or not, that's up to you. But take a look at the business model canvas out there online. You can Google it. I'm sure you'll get many hits. That's a good template to use. And the last question for now is from Alan. How do you protect yourself from idea theft when raising money? You can't really, because even if you signed NDAs with investors, even if they were willing to, it doesn't really protect you from idea theft. And that's just unfortunate. It's part of the risk that you're taking on, but it is also generally unlikely that someone who's not as committed to your idea and seeing it as clearly as you are is going to be able to execute upon it. And in some fields this does not apply, especially like biotechnology, and if you're putting something very sophisticated like that together, then there are risks that someone can just steal it, and then just the act of knowing that is very valuable. But 9 times out of 10, the idea by itself is not worth anything. It's only worth something if you execute against it. And then earlier I said ideas are important, and they are, but by themselves they're not worth anything. So I think that for most cases, and Alan, I'm not sure if this is the case with you, but for most cases, you're much better off just assuming that it's a risk and defending it by having the top ability to execute against it, and then just going full out for it, and then no one, even if they tried, will be able to catch up to you. All right, everybody. Well, that's it for today. Thank you for joining us. Again, I just wanted to say we will be sharing a brief survey after this, and we really, really appreciate it if you could take a minute or two to write out some comments about what we could be doing better or different to make these webinars be as worthwhile or better to the next batch of guests that we have with us. So good luck with everything. Change the world. It's in your power. And we hope that you think of us to support you when the time is right to do some fundraising. So go at it, guys. Take care. Bye-bye.